There's always something going on. There's never this calm world, but these are big things. Trade, Brexit, global possible recessions. It does feel like more of a risky time than maybe any time in a decade. I don't think that's an overstatement. So how do you manage investments through this time of really sort of huge risks?
Yeah. I try to do no harm and take the Hippocratic Oath, because sometimes you'll want to react to the day's news. You'll want to buy when you think when things are really good, like today, and you'll want to sell when it looks like there's no bottom in sight. Really, what you just have to do is stick with some principles around companies that you really like. Stick with quality, particularly right now. And
that's easier said than done when we got images of people throwing Molotov cocktails in Hong Kong and the police attacking protesters, and we might have another prime minister in the UK in just a couple of weeks.
Yeah.
It's hard to stay chill.
That's right. That's right. And the way, but again, if you can come back to some centralized financial themes or metrics, and the one we like the most is return on invested capital. When we look back 5, 10, 15, 20 years, that seems to be the metric that outperforms in all different kinds of markets.
So where are you finding this return on invested capital these days?
Well, you know, software companies have a lot of it, but a lot of in what we would call industrial technology companies, companies that look to deploy capital as efficiently as they possibly can, and always are looking at reducing the amount of capital that they put into their businesses. Those are all companies that generate a lot of cash and have the ability to take advantage of dislocations in the marketplace by making acquisitions at much more advantageous prices. They can take advantage of the situations that you have, particularly when there's turmoil.
So it sounds like technology of various kinds, you believe, is kind of a port in the storm, so to speak.
Well, you know, it's very interesting because we think of industrials, you think of Caterpillar, Deere, you know, those the deeper cyclical type of businesses. But there's a whole cohort of companies that really are technology-like in their approach to running a business. And those are the companies that we want to stick with. And those are the types of businesses that are focused on those principles. And again, return on invested capital, to me, is the report card for the CEO.
And I'm going to kind of dial it to the industry I cover, which is oil and gas. I mean, is that why people have just completely, like, literally left oil and gas stocks out to die? Because many oil and gas names, their valuations are trading at the same level as when oil was at $15 and $20 per barrel, but nobody seems to care.
You know, we were just looking at Devon Energy the other day. The stock is where it was today when oil was $20, $21
Exactly my point. I had no idea you were going to say that. Exactly my point.
Exactly. So those are, we don't own any of those companies.
But not, so there's you don't find the valuation yet attractive enough, even though some of these valuations are at all-time lows.
Energy has so many things going against it and one thing going for it. The only thing it's got going for it is higher prices more recently off of the 2015, 2016 lows. But what they have against them is a whole host of issues. You know, an emerging class of investors that just don't want to own carbon-based businesses at all at any valuation, and a less disciplined industry in terms of how they allocate capital simply does not exist.